At a rally in Wisconsin, the US presidential candidate Donald Trump issued a stark warning to countries considering moving away from the US dollar for international trade, a trend known as de-dollarization. Trump pledged to impose a 100% tariff on any nation that shifts away from the dollar, intensifying his protectionist trade platform. He emphasized that abandoning the dollar would effectively mean losing access to the US market, making it financially unfeasible for such countries to continue business with the United States. Trump framed his stance as a defense of the US dollar, which he claimed has been under major siege in recent years. The former president expressed concern over the growing discussions among nations like Brazil, Russia, India, China, and South Africa about conducting trade in currencies other than the US dollar. At a summit last year, these countries explored ways to reduce reliance on the dollar, a development Trump aims to counter aggressively. He reiterated his desire to maintain the dollar as the world's dominant reserve currency, despite the decline in its global dominance over the last few decades. While the US dollar still accounts for nearly 60% of global foreign exchange reserves, there are growing concerns about countries looking for alternatives. Trump's harsh approach to tariffs is designed to halt this shift, but some analysts warn of potential negative consequences. Ulrich Leutmann, head of foreign exchange research at Commerzbank AG, cautioned that Trump's proposed tariffs could backfire, incentivizing more countries to abandon the dollar and causing major disruption to global markets. This could ultimately weaken the dollar's safe haven status and trigger a significant depreciation of the currency. Despite the risks, other strategists argue that Trump's focus on driving US economic growth and his protectionist trade policies might bolster the dollar's strength. The unpredictability of campaign promises and the complex nature of global currency markets make it difficult to forecast the exact impact of such a policy. With the dollar supremacy on the line, Trump's bold tariff proposal has added a new layer to the ongoing debate over the future of the global financial system and the role of the US dollar in international trade. De-dollarization refers to the global shift away from the US dollar as the primary currency for international trade and financial transactions. This movement has gained momentum in recent years, driven by a variety of factors including geopolitical motivations, economic sanctions, and a desire for financial independence from US influence. One of the major reasons behind this trend is the geopolitical pressures many nations face. The US has used its dollar dominance as a tool of foreign policy, imposing sanctions on countries like Russia and Iran. In response, these countries have been seeking alternatives to avoid economic restrictions. Russia has increasingly settled its energy exports with countries like China, using non-dollar currencies, particularly the Chinese yuan, especially after the sanctions imposed following the Ukraine war. Nations, particularly those in the BRICS bloc, are advocating for reduced dependence on the dollar to minimize their vulnerability to US monetary policy and diversify their foreign reserves. China has played a leading role in this effort, gradually increasing the use of its currency, the renminbi, RMB, marking a significant shift from the previous reliance on the dollar. This shift is not limited to China alone. Brazil and Argentina have also embraced the yuan for certain bilateral transactions with China, signaling a broader adoption of non-dollar currencies in international trade. Financial independence is another key motivation, especially among nations in the global south. Countries like those in the ASEAN bloc, Southeast Asia, have pushed to reduce their reliance on the dollar by facilitating cross-border trade in their local currencies. A notable initiative in this regard is the BRICS pay system, which, once fully operational, would allow BRICS countries to settle international transactions using their own currencies, bypassing the need for the US dollar. Despite these efforts, the US dollar continues to dominate global finance. It still accounts for around 59 to 60% of global foreign exchange reserves and is involved in 88% of global foreign exchange transactions. The share of the yuan is steadily growing as countries like Russia and China push for more RMB-denominated trade. The yuan's role is further solidified by initiatives like the digital yuan, which offers a technological alternative to the dollar-based financial system. Several countries have initiated moves to reduce their reliance on the US dollar in global trade and financial transactions, with ruble-yuan transactions growing 80-fold. Russia has also engaged in discussions with Iran to create a cryptocurrency backed by gold to further bypass the dollar. China, on its part, has aggressively pushed for the internationalization of its currency. As of 2024, over 50% of China's international settlements are in RMB, surpassing the US dollar. Particularly in the BRICS bloc, have also taken steps toward de-dollarization. Brazil and China now conduct a portion of their bilateral trade in yuan. Saudi Arabia has signaled openness to pricing oil in non-dollar currencies, breaking with its decades-long practice of using the US dollar for oil contracts. In Southeast Asia, countries like India and the UAE have begun discussing using local currencies such as the Indian rupee in trade, especially in non-oil commodities. These actions reflect a broader effort by several nations to shield themselves from US economic sanctions and the volatility of the dollar's value. The potential impacts of de-dollarization on the US economy could be significant, though the extent of the consequences depends on how quickly and widely the shift away from the dollar occurs. One of the main concerns is the possibility of increased inflation. Historically, the US has benefited from lower prices by outsourcing production and importing goods from countries that trade primarily in US dollars. As more countries move away from the dollar, this dynamic could change, potentially leading to higher inflation in the US. Additionally, the US has relied on the global demand for dollars to finance its national debt at lower costs. If this demand decreases, borrowing costs could rise, increasing the US debt burden. Another critical risk is the loss of the economic tools the US has historically used to navigate crises during the 2008 financial crisis and the COVID-19 pandemic. If the dollar's role as the world's reserve currency diminishes, the US could also be weakened. The dominance of the US dollar has allowed the country to exert considerable control through economic sanctions. Finally, the dollar's reduced role as the global reserve currency could lead to increased volatility in US financial markets. A significant move away from the dollar could disrupt the stability of US financial markets. That's all for this video. Thank you for watching this video. Please consider expressing your support by liking it and subscribing to stay connected with our Trees Economy community.